I'm Michael Fox, and this is the Prospector Podcast. And I have joining me returning guest and friend Chris Temple of the National Investor. Welcome back, Chris.
Hey, Mike, how are you?
I am doing well. Thank you for taking a little bit of time out from the family world tour that you go on every summer to discuss the Fed and what happened yesterday.
Yeah, it's more people than not were surprised that the Fed went with a 50 basis point cut to start this, whatever you want to call it, off. Powell called it recalibration, which we'll discuss. Not unlike what we discussed in the past of a mid-cycle course correction. So, for present purposes, I think that a lot of the bulls and the whiners on Wall Street that wanted a bigger rate cut just to keep asset prices goosed, they got their way. Powell, interestingly, as we'll unpackage here, gave a pretty reasonable tactical explanation as to why they started right now the 50 basis point cut. Doesn't mean there's more like that coming. What they did point out was that this is at the beginning, as he said, of a process to hopefully get back at some point in the next year or so to more of a neutral policy stance. He went to some pains to remind everybody that they are still restrictive, so that no, as he said in answer to one of the questioners in his press conference later, they have not run up they're not putting out the mission accomplished sign quite yet for inflation, even if they are more worried now about the job market and the economy broadly than they are inflation. So we'll see. I mean, I think that with all of the straining at gnats and swallowing camels over the size of the rate cut, people are going to soon look at the big picture of things as far as to where we're going. The behavior of the yield curve in the last 24 hours, I think, gives us some glimmer of where we're going. And as you and I talked about the last time we visited, once the Fed does start cutting rates, it shouldn't come as a surprise to anyone if a year from now the Fed indeed gets to that 3.4% level on the federal funds rate at the end of 2025 that they predict, but that at that same time, long-term rates are higher than they are right now, because that's where we're heading for a variety of reasons. And I think the initial euphoric reaction to most asset classes levitating on this rate cut, they're only looking at what they think today is the story. They're not understanding that we're going to still have tight interest rates, especially for most all borrowing costs down the road. The Fed can lower the short-term rates how much it wants, but when you've got the governments of the world and you've got inflation that's still going to stay sticky, perhaps rebound, the picture a year from now is not going to be as rosy as people are looking at today.
Yeah, I personally, I was really surprised at the 50 basis points. When we last talked about Fed policy, you were all in on 25 basis points as a cut for this one here. And as I said, I agreed with you, but I said at the same time I could have made a very strong argument for the Fed to do nothing. And then I laid out the points in that. But to go from nothing to 50, it was kind of shocking.
Yeah, but when, if the federal funds rate was 2% to start out and they did 50, that would be more shocking. We're starting out, with the federal funds rate having been 5.25% to 5.5% range. So lopping 50 basis points off of that isn't quite as dramatic. And again, when Powell was asked about this yesterday, well, why did you start out? He actually suggested that had the Fed had a couple of the data points back for the July meeting that it has now, that maybe they would have done 25 basis points in July and 25 more now. So in a way, they were kind of making up for it. He also pointed out that, look, we're the last central bank of note to start doing this. Everybody else has cut rates once or twice or whatever, whether it's the ECB or Bank of England. The only one going in the other direction of note right now is the Bank of Japan. That's a little bit different dynamic. That's a story for another day that I don't think is going to have a major impact on all the rest of this stuff. But again, he stressed, and again, the tactical roadmap that he laid out is that they have shifted their focus to more of a balance between the labor market and inflation, if not favoring supporting the labor market. They've seen enough weakness; they don't want to see it fall off a cliff. Okay, so that I get. Tactically, even though they're looking at going to that neutral rate, by the end of 2025, which would be 50 basis points more of cuts before 2024 is over and 100 next year. He said, we may speed that up. We may slow it down. We may suspend it. We're going to do what we have to do. So the irony is, especially when you look at a decent jobless claims number this morning, that if the economic stats don't fall off a cliff right away, they may slow down. So they may start at 50, but then do a couple of 25s or something like that. So, he was trying as best as he could to still keep some optionality, to have the markets guess a little bit as to what they might do. So I think that from this point going forward, especially having started with his 50 basis point cut yesterday, Mike, that the surprises from here on out will be more in a form of a disappointment if the Fed goes to 25 or skips a meeting here and there, rather than that they're going to panic and actually accelerate rate cuts. And I've said this all along, that once the Fed gets to what they previously called a mid-cycle course correction, I guess that's too long of a phrase. So yesterday, 9 times by, I think it was Steve Leisman's count at CNBC, he used the term recalibration. That's where they're going. They're going to this recalibration. It's not a rate cutting cycle. They're not going back to zero. He made that very clear yesterday. That was an historical aberration as far as he was concerned. So again, I think that the market, as they have, been anticipating for a while, and as you and I talked before, the markets are by today's behavior, at least we'll see how the day ends. We're recording this Thursday morning. But they're thinking that this rate cut is a start of a path back to zero, and it's not, and it can't be. And again, as I said a minute ago, especially at the long end, when you look at the massive debts in the world and everything else, I mean, Gary Cohn, who worked in the Trump administration, made exactly this point this morning. Jeffrey Gundlach, one of the best bond gurus around with double line, he said this in his comments after the Fed meeting yesterday. If you were smart enough, and I wasn't because I didn't trust the move, and you went long Treasury bonds from the peak yield of around 5% to the bottom at around 3.6, you made a nice trade, that's over. And both of them made the case, as I have said, and I will continue to say, that as the Fed cuts short-term rates, long-term rates are actually going to move higher into next year. So you definitely don't want to be betting on the long end of the Treasury market. Short end, you could do a little bit, but not on the long end. And that's the environment we're going into. And again, this is something that is lost still on Wall Street, thinking that across the board we're going to go back to zero interest rates or something close. That's not going to happen, and mathematically it can happen.
Yeah, I like the term recalibration because that's what my GPS always tells me when I make a wrong turn. It's recalibrating. So
Yeah,
that seems really appropriate when you get caught by surprise with the Fed. But let me ask you this. If we go back in our history books and we take a look at the 1970s, there was some rate cuts that happened with Volcker, and that didn't go well. It just lit the fuse for future inflation, and that future inflation was way worse than the inflation that led up to the rate cuts. Has Powell lit that fuse?
well, first of all, let me correct you, because before Volcker, it was Arthur Burns who, just to give you a quick Cliff Notes version of this. In 1971, as everybody knows, Nixon closed the gold window, made the dollar a free floating thing. Back in those days, all the other central banks of the world had not yet done this like they have since. So it was uniquely the dollar that was getting debauched and going down in value. So for a spell after Arthur Burns, who was Nixon's Fed chair, caused the first wave of inflation in the early to mid 70s that had to come on the heels of, closing the gold window, et cetera. He saw the economy weaken. We had a recession and so forth. And to try and help, mollify the effects of the recession, or mitigate, I guess I should say, he started cutting interest rates. But then inflation did reaccelerate and it got worse than it did. And Powell, many times during this journey of the last couple of years or so, has repeatedly pointed back to that episode as the reason why he wanted to wait so long himself before cutting interest rates. He did not want to repeat that mistake. Now, when you understand the history of how afterwards Paul Volcker created the regimen of asset price inflation in the early 80s that we have had since, Powell was asked yesterday, by being aggressive at the front end of this and starting to ease policy at a time that you've got record high real estate prices, record high stock prices, which, theoretically we're going to add to those, at least in a knee-jerk reaction with lower interest rates for a while. Aren't we going to risk reigniting that? He was asked that question. And for the moment, at least, he's dismissing that. The Fed is making a gamble right now that it did wait long enough to start the cutting. And now there are things in place where they will not repeat the mistake that Arthur Burns did of relenting too early and then having to raise rates again aggressively later. We'll see how that works out. This is not the 1970s, but then again, neither is it the 80s and 90s and aughts when we had a general environment of disinflation. So, this is going to be different from both of those going forward. How much so remains to be seen. But, clearly there is a risk that if the Fed gooses asset prices too much and that trickles down, we're going to see a reacceleration in inflation.
Yeah, and that could take the bets off the table for further interest rate cuts going forward.
Well, Mike, and that's why he said yesterday that if if they start to see that kind of a thing, they'll stop cutting rates. They're going to do whatever they think they need to do. And I think to some extent he's not being disingenuous. I think he's being sincere. And that, look, it was 14 months since the Fed made its last rate move in July of last year. And in that time, inflation, the headline inflation numbers dropped by well over half. The economy has throttled down a bit. So look, I get some of the justification of why they're going to, at least knock things down a little bit, do this recalibration to where maybe a 3.5% federal funds rate by the time we get to the end of next year will be more reasonable in a world of a slowing economy and whatnot. We'll see.
Yeah. Well, I was going to make the comment about, everyone's anticipation of the Fed pivot. They were looking forward to it. And of course, yesterday, you can mark exactly when Powell made the announcement because the markets fell off dramatically from that point on. But I was going to comment that it was like the dog had caught the car. Now it doesn't know what to do. But, we're half an hour into the day's trading and, the Dow is sitting up at record highs, and toying with 42,000. So I guess the dog knows how to drive the car.
I guess so. Listen, I alluded to this a second ago, and this is very important to keep in mind with this whole thing. Paul Volcker, who you referred to and I referred to a minute ago, he came in after inflation had been raging for several years on and off. It was terrible as we got into the late 70s and 1980, and he jacked up interest rates dramatically to choke off inflation. It caused a massive recession at the time. At the time, it was the worst recession since the Depression of the 1930s, but mission accomplished. Everybody remembers Volcker for that. What very few remember Volcker for and what his true legacy is that we live with today is that after that, he inaugurated the regimen of asset price inflation as the first and initial driver of economic activity. Prior to that time, Mike, and folks who are listening, inflation was more what a lot of people still take it as today. You know, the price of goods and services goes up, et cetera. But Volcker figured out a way in the 80s to lower interest rates, inflate the money supply dramatically. The money supply under Ronald Reagan went up several times greater rate than it ever did under Jimmy Carter. People have long since forgotten that. But that inflation, unlike in the 70s, did not go as a first matter directly into the prices of goods and services. It went into asset prices. That in turn gave people this, what we came to know as the wealth effect, trickle down to the broader economy. And so it has been asset price moves up and down that have been the main economic driver, really, ever since that time. The debt levels correspondingly went up, exponentially from where they were. It was Ronald Reagan who presided over the first $1 trillion total national debt. Now it's 35 plus and still going. And most all of that along the way came from a massive increase in the money supply along the way. But for 40 years, from the early 80s until just a few years ago, that never really in a big way went through to the Main Street economy. It all stayed in asset prices because there was a lot of governors on price inflation, mostly globalization that kept wage levels down at the expense of Canadian and American and European workers. A lot of stuff started getting made in other developing nations. That kept wages down. And a lot of other policy things through free trade and globalization did that as well. The trouble now is that Powell is going to relent and hope that inflation is done when a lot of those dynamics have changed. And you've got a lot of reasons why, notwithstanding some weakness recently over fears with China, that wage levels globally are going higher, even in the Western world. You've got commodity prices that are under some stress that eventually are going to continue to work their way higher after some recent weakness for some of them. So I'm not sure the Fed is going to successfully pull this off. So what they're doing now, to sum up that long-winded, recap of history, is the Fed is going back to the Volcker Act 2 playbook, where they're going to continue goosing asset prices to keep everything levitated and hope that it's not going to trickle down. He made some in this sense, and we talked about this specifically when you and I had our last conversation, Mike. Volcker made some especially disingenuous comments in one respect yesterday, and that was when he all but ruled out monetary policy as having had anything to do in the first place with the inflation that bubbled up in the last 2 or 3 years, and blamed it all on supply chains and things like that. And so he's saying, well, now that we're past COVID and the supply chains are back to normal, that's another reason why he's going to lower interest rates. So that's the biggest one that may come back and bite him.
Yeah, I definitely agree that's going to come back to bite him. You and I, oftentimes, we talk about the eye test when we're dealing with the economy. There's the data points, which data can be, tweaked and maneuvered and spun, but where the rubber hits the road, our eyes tell us what's actually happening. Now, you've been traveling all over America. I just came back from a precious metals conference in Beaver Creek, and my eye test is telling me we've got two economies: one for the poor and the middle class, and another one for rich Americans. What have you found?
Oh, I found exactly the same, and even more so, Mike. I think that the stratification of the economy is getting more acute. A lot of people have commented on that in the economic and financial press, and even more broadly. I do think that even though he didn't want to come right out and say this, that Powell has some understanding of this is lurking underneath the surface, and maybe it's part of the reason why they started out with a 50 basis point cut. Time will tell. But look, economic statistics are inflated and have been for a long time by financial market activity and by stuff that really doesn't represent the real world experiences of Joe Sixpack and Sally Soccer Mom. And just in the recent past, what I have seen personally with my own eyes, I just left yesterday to start the trek back home in a couple of stages from northern Wisconsin, northern Minnesota. Those areas are very busy typically in the summertime. A lot of vacationers from the Chicago area, from the Twin Cities area mostly, that go up in those areas. And I will tell you that this summer, my observations are that there was a noticeable drop off in overall activity from what I saw last year and before. And accepting how things really fell off for a short time during COVID. But judging by what traditionally is average, there was a noticeable subpar, environment, I think. That came after, actually, if you can Google this, folks, Airbnb in itself announced earlier this summer that they were seeing fewer bookings, things are not full. They're seeing some weakness, people starting to pull their horns and not travel as much, not rent things as much. While I was up north, a buddy of mine who I usually see once or twice a year up there, and then when he and his wife come down to Florida for a while in the wintertime, he's a long haul truck driver, does stuff, not across country, but pretty much regionally in the upper Great Lakes area. He previously was taking a full weekend off. He had so much work to do and was making sufficient money from Monday through Friday that he stayed home on the weekend. Now he's telling me, number one, that he's only taking 1 day a week off on the weekend because he's trying to get all the business he can. It's somewhat weaker rates right now while he can get it, number one. And number two, he said, and he shared a couple anecdotes about a couple of areas where truck drivers congregate for loads and for work and things like this. And he told me that more than once in the recent past, there were some areas where he would have to sit in line for a while and he gets right in and out. So add all of that up and there's considerably less activity. Last but not least, in the first trek of my trip back home yesterday from Northwest Wisconsin to right now where I'm sitting just outside of Indianapolis, the only time I've seen less traffic than what I saw yesterday on the road, and I'm talking commuter traffic, again, vacationers, that's winding down now. But even trucks and tractor trailers and stuff. And, coming up on areas on major interstates where it's cut down to one lane for a while, usually, which means you got to crawl along for 15 or 20 minutes. The only time I saw is less traffic than I saw on the highway yesterday so far was when I had to make a quick run to tend to my father who had an accident not long after things crashed in 2008. And I drove from northern Wisconsin to upstate New York, and things were pretty sparse because people were still staying home and business was weak and whatnot. So if I add all of that up together, it underscores the fact that underneath what are still relatively healthy economic numbers, the soft underbelly of the economy has become greatly more exposed recently. And perhaps that's one reason, unspoken, why Powell did what he did.
Yeah, I'm in agreement with everything you said. Like, we took a trip to Boston. We extended a week, and my wife had to go to Boston for her work for a day. So we made a bit of a holiday out of it, and we had no problems getting restaurant reservations or in on short notice because it was a short notice trip. We did a little sightseeing. We did a walking tour. You can't gauge by that because it's a walking tour, but you can gauge by the tour buses, those hop on, hop off deals that most major cities have. Those buses weren't full. They were, at best maybe half full, if that, in a lot of cases. So that would indicate to me that travel was down dramatically. I live in Charlottetown on Prince Edward Island, as people know. We're a very touristy place in the summertime, and it's generally very hard to get reservations to go out for dinner and that. We haven't had that kind of problem this year, so that's another sign that things are a lot slower than they have been in the past. But we talk about the bifurcation of all of this. Like I was at Beaver Creek last week for the Precious Metals Summit that's put on there annually. And a couple of observations that I had from talking with the service staff, talking with the Uber drivers, talking with the locals there was that the resort itself, atypically, it had been pretty quiet through the summer and into the fall. And a lot of them said they wouldn't be working at all if our conference hadn't been in town that particular week. But at the same time, as we said all of that, I'm out at the Eagle Airport, coming in and leaving to get to Denver, and not a word of a lie, there was a minimum 24 private jets sitting on the tarmac there. And for those who don't know geographically, Beaver Creek is just up the road from Vail, and Eagle is the closest airport. So obviously, those with money are still fine, where the poor and the middle class are the ones that are suffering, and that's not showing up in the data at all. So the question I have in all of this is, that being the case, is this an economic data problem that the Fed needs to solve, or is this a political problem for whoever comes into power next?
Well, it's more the latter, I think, because amid my driving on the road and having CNBC and or Fox occasionally on the road, all the way down, trying to keep up with what's going on in the world and things like that. The point was made, and this harkens back to a couple of my comments that I made with you earlier, Mike. The dilemma that the Fed has and that the economy has, and that whoever wins the elections for White House and Congress both this year are going to have, is that we've got a $2+ trillion annualized deficit now, at a time when we arguably are coming off the end of a major economic boom / rebound from the self-inflicted recession of COVID. If we do see more economic weakness and tax receipts go down and things like that, which typically happens at times like this, you can look back at perhaps at a $2 trillion deficit and say that was good, because it's going to get a whole lot bigger if the economy weakens and so forth. So the only way long term, and Jeff Gundlach made a great comment about this yesterday too, afterward, is that what do you do for an economy that is slowing, that has massive debt overhang, where the households have massive debt overhangs, and as you and I just got done talking, are already pulling their horns in on things that are discretionary rather spending. How do you move the needle? How do you reinvigorate economic growth and make it easier for people to service their debts and for the economy to grow? And the bottom line is, you must increase output. And this is Powell alluded to yesterday, and you and I mentioned in our last conversation. This is already something where the Fed is trying to get out in front of this and deflecting blame from itself over what comes in the future from the economy, because I think that for all of their mistakes, they have sense enough to know the overall landscape, and that at this particular point in time, cutting interest rates on the short end is not going to do a whole hell of a lot to change the course of things, which is going to be that the economy will continue to slow down, and inexorably, the even people with money are going to get sucked into the vortex of a weaker economy, everybody drowning trying to service debt. And that's not going to do a whole hell of a lot for growth. And it's going to explode deficits even farther, et cetera. So this is more than what the Fed can do anything about, going to be a policy matter for the next U.S. government, after, a while after that, for the next Canadian government, et cetera. And what do you do? What is everybody's game plan to be able to broaden economic growth in a substantive way, not give away money, not just cut taxes, because neither one of those things directly will increase output. But what do you do for the economy? And, that's one of the reasons why, lurking in the background, even though it's still a little bit premature to have a green light and be uber bullish on commodities generally, it's why I still like commodities and their story longer term, because when policymakers grapple with this, and assuming they do it at least half right, you're going to see a disproportionate benefit for green energy, conventional energy, infrastructure, and a whole lot of stuff, because that's going to be the only policy move where, if it's done right, it will broaden economic growth, it will increase wages, and all of that thus will, make the debt load that we have today a little bit easier to bear. So the Fed has already started the verbal process of getting this monkey off of its own back. And they'll continue to do that, because when all is said and done, this is going to be a policy matter.
Yeah. Okay. So moving forward, what kind of red herrings, black swans, oopsies, do you see that could occur here over the next little while that could sway the Fed and change the economic outlook?
Well, I said earlier that, we can make some parallels or draw some parallels and inferences maybe from the lesson of the 70s, where the Fed, in retrospect, they relented too early back then on inflation. Inflation reaccelerated. They had to respond to that. It's not going to be all the same as that, but we may see some pattern. But here again, there are things that are going on today in the world that are unprecedented, where there is no prior example of what do you do, for example, when the second biggest economy in the world, China, is in full on deflation and could drag everybody down. That's one benefit, arguably, that Powell and the Fed have right now in starting to take their foot off of the brake, so to speak, and reduce interest rates in the hopes that inflation won't come roaring back, because you already have, and we've seen this, and this is one of the reasons for my comment a minute ago on commodities. China is in full on deflation in that country. Their economy is in major trouble. They, more than anybody on the planet, are having a problem with their debt colossus over there right now. If they fall out of bed, then everything tumbles for a while. Then the Fed does have to go past, this recalibration to neutral and become accommodative as part of a global effort to keep everything from going down the toilet bowl. So that's one of the potential surprises out there, I think. Another one obviously is war. Last week, thankfully, Biden and Starmer blinked when Vladimir Putin made very clear that, look, if U.S. and NATO technology is responsible for striking deeper into Russia, there's no Ukraine in the middle anymore. You've declared war on us, and I'm going to respond. And so thank God they've stood down from that right now, because they've been spoiling for this war with Russia for a while. Now maybe cooler heads are prevailing. We'll see. The flip side of that is what just happened in the Middle East, and some next level spycraft to get, I don't know, a couple of thousand pagers or phones or whatever in the hands of Hezbollah. That's out of a TV script.
I was going to say, where's Tom Cruise and all of that? That's like right out of Mission Impossible.
Well, and for those who ever watched one of my favorite modern day series on TV was one called Castle. There was actually an episode where Castle's father slipped a plastic explosive into a walkie-talkie that he knew was going to end up in a bad guy's hand. So I mean, that's weird stuff. But obviously, war is another thing that will upend things. Hopefully, we don't see that, but that's something that you've got to have in the back of your mind. You don't make all your plans based on that possibility, but it's got to be in the back of your mind. So those would probably be the two biggest surprises. The other one is, we have no idea today. I wouldn't want to bet even now on who is going to win the U.S. election, but there's going to be some fallout from that, no matter who wins, and not only because of what the policy differences may or may not be, but the losing side, whichever it is not going to take things kindly here. And so you've got to also have in the back of your mind, you don't invest today based on this necessarily, but you've also got to have in the back of your mind what happens if, instead of COVID shutting down parts of our day-to-day economy and society for a while, it's domestic, issues and insurrection. that happens, and you can't rule that out. You don't bet on it, but that's another thing that, how or if the Fed could respond to such a thing, we don't know, but that's also out there as a looming possibility. So, I think that the base case is that we're still evolving into this great stagflation, maybe differing in some degrees from the stagflation of the late 70s, but the pattern is still going to be the same. And again, punctuated by massive debt. So much so that it's going to take something more than the Fed cutting interest rates to solve that, because that debt overhang itself guarantees that we are going to eventually see a broader recession than what we have right now.
Yeah, it's interesting times for sure. All we know for sure at this point is the Fed pivot has appeared to have begun, and you and I are going to have lots to talk about in the months to come as it rolls out and we see the effects of it. If people wish to follow you and learn more about your thoughts on the general economy, as well as some of the stocks that you think are excellent value, how would they do so?
Simply go to nationalinvestor.com. There's way on there to sign up for our mailing list, as well as to follow me on social media, and I recommend both.
Wonderful. Thank you again for joining me, and I look forward to our next discussion. We got an election coming up, so I suspect that our next discussion might be that. So,
well, it could be that, but don't forget, and we didn't really talk about this today, something that there's, others think is going to be a bigger deal than I presently think, is that don't forget that come October, you've got this big BRICS summit. And it'll be interesting to see what comes or does not come out of that.
Yeah. Again, lots of things interesting to talk about. Thanks again, Chris. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.